there's money to be made in this pseudo arbitrage of mergers and acquisitions. When a company goes out and says, hey, we have money, we want to go buy another company that we think will slot well into our business, you're no longer relying on what the fair market value of a company is. You're relying on whether a particular event will occur. It's not really like arbitrage, but it's kind of like arbitrage. A couple of examples of this. Right now, what's going on with Aya Healthcare and Cross Country. This is something that's very interesting, I think. Aya Healthcare is acquiring Cross Country for approximately $615 million in cash. This was December 4th of 2024. The company is still trading. Company's still trading. It's $11.26. Aya Healthcare has agreed to pay $615 million in cash or $11.61 per share for Cross Country. And right now, Cross Country is trading at $11.26. Let's say you go out and buy 1,000 shares for $11,220. Assuming you're correct, you get paid $18.61 per share. That comes out to about $7.39 extra, as opposed to where it's trading right now. The difference is about 40%. The problem is, this is the same thing that happened with Activision Blizzard. The market right now does not think that the FTC is going to allow Aya Healthcare to actually buy Cross Country. And so they leave this giant margin in case it doesn't get bought. Cross Country Healthcare is, I think, a pretty solid company. We've seen the revenue go down quite a bit, but this is also in relation to coming off of the pandemic. It's down 40% because when the merger was initially announced, it went from $11.16, which is where it's kind of at right now, to $18.16, right? Basically the closing share price. And then everyone realized, oh, wait, actually, this might not be the best stock to buy right now. I think that this is a great company that's being taken private. And it's a company that I would want to own, like, just regularly. I wouldn't be upset even if this sale didn't go through because like they have strong and growing cash flows. They have like 10% of the market. Another fairly interesting opportunity here. This is a company I talked about a while ago, Kenvue. Kenvue is a company that was jettisoned off of Johnson & Johnson. Yeah. Johnson & Johnson had a lot of really toxic brands. They also had a lot of really good brands. And so they packaged them all up very neatly into kind of their own little company and just kind of like threw them away. And that company was Kenvue. You know, the big brands that they had, Tylenol, Listerine, Johnson's, Aveeno, and Neutrogena, big recognizable brands. Kimberly-Clark sort of came out of nowhere and said, hey, we want to purchase this company. There's currently a giant arbitrage opportunity with Kenvue right now. I started buying Kenvue after the Secretary of Health and Human Services came out and said, hey, this one of the core sort of brands of Kenvue causes autism. And it's like, well, okay. The stock is going to tank a lot on the news, but I think it's like in general going to recover. And so I started buying a bunch of shares. And then all of a sudden, Kimberly-Clark was like, hey, you know what? We just saw the stock tumble. Maybe we can get a slightly lower price. We're still obviously going to offer quite a premium. Kenvue is currently trading at $32 billion and they've been offered almost 50. So as sort of another sort of arbitrage opportunity here, I think that this is another very interesting idea. Fulton Financial, a kind of a big regional bank, has decided to buy Blue Foundry Bancorp, another much smaller regional bank, in an all-stock transaction. Under the terms of the definitive merger agreement, each share of Blue Foundry common stock will be exchanged for 0.65 shares of Fulton common stock, based on Fulton's share price of $18 on November 21st, 2025. The transaction is valued at approximately $243 million, or $11.67 per share of Blue Foundry common stock. They're trading at $11 a share. It's not much. It's 67 cents per share. And that's unfortunately one of the big problems that you run into with these sort of mergers and arbitrage opportunities. Typically, when a company comes out and says, hey, we're buying this other company, the per share trading price is going to pretty quickly reflect that acquisition. But occasionally, you get some weirdness in the market. Like with Kenvue. Kenvue is getting discounted massively because people seem to think that the government is going to step in and block the merger. People are also discounting Aya Healthcare massively because people think that the FTC is going to step in and block the merger. I don't think so. If you're brave enough to own companies like Cross Country or Kenvue or at the time Activision Blizzard, it's basically free money. You're just getting paid to wait around.